baby. In major stock news today, we are discussing following the money with billionaire Russian oligarchs shifting capital around, affecting the global markets. We are talking about dates you need to mark on your calendar for continued volatility of the markets thanks to interest rates and Federal Reserve meetings. We're going to be going over a ton of data leading to sectors and individual stocks right now that are outperforming. And I promise you the trend will remain to be your friend. And I'm suspecting these stocks we're going to analyze are going to continue to outperform, taking advantage of this Russian and Ukrainian crisis. If this is a conversation you appreciate, in return, just help the channel out a little bit. Hit that like button, folks, because my God, there's a lot of data to talk about today. But first and foremost, kind of the fronted conversation is that this Ukraine war boosts Bitcoin and green stocks as crypto helps Russians and the oligarchs to get funds out. Now, when I say the term oligarch, something I've never heard of before, sounds like a Disney villain character, primarily related to obviously political dominance and these billionaires in Russia that have control over what's going on, shifting all of their capital, trying to hide their money because obviously with these sanctions, they're getting their yachts out of Europe, and they're primarily just shifting all of that money into Bitcoin because we're starting to see a disconnect from Bitcoin to the performance of the general markets, which is something we haven't seen in a few months as crypto's been trading down with the markets here. But just take a look, guys, to update you on the Moscow exchange is still holding these all-time lows here, or these crazy like decade lows of down 50% just in the last 6 months, and Bitcoin is holding up to about 43,000, trading up 5% today alone. No, we're not at $60,000 highs, but this is proving for those Bitcoin bulls that there is useful purposes for crypto for both sides of this war, because obviously in this conflict, a lot of people are supporting the Ukraine by sending them crypto, and a lot of these Russian billionaires are trying to get liquidity and get their money out of the country, because you're not going to be doing that with gold, and you certainly aren't going to be doing that with cash right now. So all of this continues to bode well for the use cases of crypto. But outside of that, the general markets today, guys, are flat. After seeing some rallying back over the last few days, there are only a very few sectors that are continuing to perform well, which we're going to discuss in a second. But what you need to mark on your calendar right now, because if you thought this war caused volatility, my God, we are still in a pending what could be a recession leading into some incredible interest rate hikes. And I want to talk about that because March 15th, 16th will be the first date of the federal meeting where we get to find out how much those interest rates are going to go up. My guess it's going to be the higher end. They were saying anywhere from 0.25% to 0.5%, but my guess it'll be the upper end. They may want to test the waters, but I think they're running out of time as inflation continues to take hold. Take a look at this chart here. This is the inflation rate since basically World War II here. And we can see that, through the 1980s, inflation rise where they had to go through incredible interest rate hikes was the last time we saw such aggression in the rising of interest rates here. And most people are starting to say, oh, well, it'll slow down. We'll start seeing a cooling process, but we are absolutely not. This trend continues to go up at an accelerated rate, primarily thanks to this conflict right now with crude oil here. The Brent, the barrel price right now is holding over $105. And because oil is so largely contributed to every aspect of our lives, from food to housing material and everything in between, this is probably going to be the best indicator to continue watching the inflation rate go higher. But if it continues to bode the way it is, guys, we are literally looking at the same situation we saw in the 1980s. And until this resolves, I would be quite fearful that we're going to go into negative GDP growth for a couple quarters, which equals recession. Doesn't always mean the stock market's going to do bad, but we're going to talk about how you can kind of perform pretty well with the sectors that are outperforming in a sec. But I also wanted to point out the margin rates. Now, a lot of my kind of speculation that the markets were downtrending was because in this fearful market, a lot of people could lose a lot of money because they're margined into the markets. And margin debt, we get these statistics from FINRA here, guys, are dropping drastically. Considering we hit a peak in October of last year at 935 billion, it looked like we were going to hit over $1 trillion. And then we've been downtrending coming out of December when the markets really started to get hit. We've gone from 910 billion to 829 billion, over $100 billion in just a few months, wiped out of margin. And something tells me that trend is going to continue to go down, which means less money going into the capital markets, which usually is what's going to keep the markets flatlining. Because my God, $1 trillion in margin that we almost hit is astra bloody nomical, guys. And this leads into the volatility index here. For those of you that don't know, the VIX represents the in and out flows of just stock trading and what's going on. And we are hitting literal volatility levels we haven't seen since basically March of 2020. These are 1-year highs, really representing the skittishness and all this capital moving around within the markets, which again is leading very well for gold, which I was shocked to find out that Meet Kevin actually liquidated his gold position a few weeks back, probably a little bit earlier than he should have. I know he put some of that money in Enphase, so congrats Meet Kevin, because Enphase has done great. But I think this gold trend is going to continue to remain your friend here, and it's going to be neat to see. And I would pay attention to this even if you're not investing in it, because I don't really invest in gold that much, but it will be neat to see how it responds off the interest rate hikes that are going to be coming up mid-March. And I'm telling you, the Fed's going to be way more aggressive than people are anticipating because inflation is not getting under control here, folks. So let's continue this conversation by looking at the stocks that are taking the benefit of everything that we're talking about here, with first and foremost the oil sector, which I've been updating recently, and Exxon is bumping off the recent sell-off over the last few weeks. It's up 4.21%. So this is something that I would highly pay attention to in the upcoming earnings for Q1, because honestly here, guys, at these margined levels, these companies are going to continue to print. Enbridge, the Canadian side of the border, not nearly as exposed to kind of the oil and gas sector because they do have some renewables. They do deal with natural gas and a lot of other facets, but oh my God, outperforming for the Canadian sector with a massive 6.21% yield, and Exxon paying a 4.46% dividend yield. A lot of you are kind of in these safe companies, or not safe companies, but these kind of, you know, what are they called? The war companies like Lockheed Martin here that primarily build jets. They deal a lot with aerospace, a company I used to have exposure to. A lot of you have asked me about, and honestly, Lockheed Martin, I don't know if I'd be buying it now, because as soon as these tensions cool off, this could just be a cyclical run up. And usually when we see these massive run ups, again, just like we saw with coming out of 2020 into 2021 with all of that hype within small caps, I think now wouldn't be the time to be starting positions in this. But if you have a position in it, I congratulate you. I wish I didn't sell my position a few months back, because I could have printed some tendies off that one. Now, I haven't talked about the smoking sector. You know, obviously when we're talking about all this conflict, it usually bodes pretty well, like it did in March 2020 here, guys, where people actually start taking up smoking more. They deal with it to calm their stress. And obviously people are hiding out here from a consumer staple standpoint or consumer discretionary with a 4.93% yield. Philip Morris has been crushing it, and it looks like they could test their all-time highs again here very soon. Enphase, as we just mentioned, this clean energy transition shift with oil out of control. This leads more people to look at electric vehicles. It leads more companies to want to invest in renewables and try and basically decentralize themselves away from the global market, because obviously in this oil crisis, if there's one thing a lot of countries are looking to do is kind of re-implement their energy to be more sustainable within their own economy. So Enphase has definitely been blowing up over the last month because of this. Northland Power, the Canadian side of the border, both of these companies kind of offer somewhat global diversification. Northland Power obviously a little bit more. I've been pumping this stock up recently because it's one of the first stocks that I ever bought here, folks, and it is rallying up quite aggressively, not only because of the last earnings cycle, which crushed it finally because they've had a bit of a slow earnings period for the last 3 quarters, but now the fact that countries are lining up to make investment capital into these kind of businesses, I really think this trend will continue to be your friend here. And outside of oil and some of these gold stocks that might be a little bit more cyclical, these things will be your friend for years and years and years to come, and they are still trading off their highs. So maybe some good opportunities, considering this one does pay a monthly dividend here, folks. So bringing this picture all into a kind of just summary, what are we looking at here? Well, we're looking at continued volatility with the likelihood of crypto continuing to do well, likely gold continuing to do well, oil stocks continuing to do well, and of course, green energy continuing to do well. I would avoid those high-flying companies that are more related to this war-driven idea like Lockheed Martin. I like MO and Philip Morris here, but obviously as these kind of tensions reside, I'm curious to how well those could outperform. But for the security of your long-term portfolio with large hedge funds and obviously these pension funds, they will continue to gobble up these carbon emission free based companies. So that's where I would be primarily allocating capital if you don't have a lot of exposure. But in this moment here, guys, I would continue to stack cash, keep having an emergency fund. You can cost average into some of these companies, but be very cautious until we get a full view picture of what interest rates are going to do, because something tells me it's going to get very aggressive if we start heading back to what looks like the 1980s on the current trend of the inflation rate. This is not going to be a fun next 3 to 6 months, but we will get the clear image, and I'm sure we're going to start figuring out where this war is going to go to by then, and we're going to have a much clearer image and kind of remove the uncertainty of what's going on with inflation and the interest rate environment. And also, I would highly pay attention to the real estate market and how it is affected by this interest raising environment. My God, there's going to be lots to talk about over the coming months, so consider subscribing because I will, of course, update you here. But stay cool, stay awesome, and as always, I look forward to catching you in the next one.